The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. Gold continues to surge. Why is this happening? What do you need to do? A couple of good questions, and we have a couple of good experts to answer those questions for you. Brad Chastain is here, and so is Philip Diehl. And Philip, I want to start with you. As the 35th Director of the United States Mint, as President of U.S. Money Reserve, why is this surge happening recently? Big jumps last Tuesday and Wednesday. What's going on?
It's a number of factors, and some of them date back to the beginning of this rally almost 2 years ago. This incredible rally. We're approaching a doubling of gold prices, unprecedented over that period of time. What I think is really driving the market right now is the tremendous amount of uncertainty in the United States around policymaking, economic policymaking, and fiscal and monetary policy making. Of course, monetary policy making is getting the most attention because of the president's attacks on the Federal Reserve, both on the member of the board, Cook, and also on the chairman, Jerome Powell. And he clearly is attempting to get a majority on the board much faster than what the traditional process would allow, so that he can have more of a direct impact on policy making, and in particular lower rates faster than the Federal Reserve seems ready to do.
Brad, there are a lot of people who expected a surge like this to happen after the Fed meets in the middle of September. Did it surprise you that it happened so early?
No, the market it tries to be as forward-looking as possible, and it is widely expected. I think right now markets have about a 90% chance of a Fed cut priced in for the September meeting now, which is the highest it's been in quite some time. And so if you're going to take advantage of an opportunity as an investor, you want to do it sooner rather than later. So markets tend to adjust ahead of time. So it makes perfect sense that it would move ahead of that meeting. And with the labor data that we've seen this week come out, quite a bit weaker, it's just really upped those bets that a Fed rate cut is coming next month, or later this month, I guess.
Yeah, that's exactly right. I mean, the old saw is buy on the rumor, sell on the news. The markets do anticipate events. Sometimes they get it right, sometimes they get it wrong. But I think the question now is not whether or not, as Brad says, not whether the Fed is going to lower interest rates in September. The question now is how many times will it lower rates this year, and by how much, and also extending into next year. So the market hasn't really looked that far beyond the September meeting, but we're going to be watching very closely what the inflation numbers are and the employment numbers are over the next couple of months. And there's a great deal of uncertainty in the market right now about which direction the economy is going. I think the general consensus is that inflation is rising. The question is, how much will it be? How much in total will tariffs have an impact on prices? And then the other question is, how weak will the economy become during that period of time because of the headwinds it faces right now?
Philip, I think all of the factors that you mentioned are the factors that are involved in the gold surge that has happened for so long, for more than a year. It was about a year ago we were talking about gold being at 2,200, and when is it going to slow down? What factors are going to continue to keep it going? Is it going to keep rising?
Well, I did a list of the factors that over the last 2 years have been driving gold prices, and I came up with 9 major factors. And really what we sort of have seen is, since it began its rally at $1,800 2 years ago, we've seen these factors tag team the market. One may sort of loosen up its impact on the market, but another one will arise and enter the ring and come to drive up prices. And we've got a perfect example of this just this year. No one anticipated that tariffs were going to be as disruptive to the world economy as they have been. I don't think anyone anticipated the geopolitical effects this administration would have as it rattles long-time alliances in the West. And of course, no one anticipated this intense attack on the Fed. So, or the administration's policy to reduce the value of the dollar. All four of those this year have been playing big roles that they hadn't been in the past and really couldn't be anticipated. I think really virtually all of those are going to continue to be in play. That's the reason why I'm confident that gold will continue to rise. And I think the question now is whether or not there's a black swan event that could arise, meaning that not only is it not anticipated, but it's an event that really can't be anticipated at this point.
Brad, with gold getting so high on the price range, a lot of people are wondering, well, I want to diversify, but is gold out of my reach? What do you tell them?
I think, first of all, being diversified is always important. And it's one of those things where if you're missing a critical asset class within your portfolio, regardless of where things are, then it's important to make sure you get the exposure to that. If somebody already has exposure, then that's an opportunity to take advantage of dips or this to add to that exposure. But if you're missing the exposure, the first and foremost important thing is to make sure you get that diversified portfolio regardless. But over the long term, I mean, it's very hard to make a case that somebody has so-called missed the boat on gold. In order to do that, you've got to think the world is going to be very different than I think most people suspect it's going to be. Because what we're talking about today and what Philip has outlined so nicely are these short-term factors that have driven price levels on a day-to-day, month-to-month sort of trajectory over the last 2 years. But this isn't a 2-year trajectory for gold either. It's it's been going for 25 years. Over the last 25 years, as we've outlined many times, gold has outperformed the stock market. And that's through all different types of political environments, geopolitical environments, with wars, different rising or falling inflation rates and the like. And so those things do affect gold price week to week. It's what we've seen cause a surge over the last week with some of the data that's come out. But the fundamental driver for gold isn't going anywhere, and it's still currency debasement. We live, again, in a debt-based monetary system where fiat currency, not just the dollar, but currencies all over the globe, come into existence by being lent into existence, which means that more has to be repaid because of interest on that. So the supply of money in the global monetary system has to keep expanding in order to keep the system going. And governments know that, central banks know that, and that's what they do. They continually increase that, and that debases the value of the currencies that we have and ultimately impacts gold. And the only way you have to think that that's going to stop is if global governments around the world, not just the United States, get their financial houses in order and stop running deficits and running up debt. And we maybe not here, but sometime maybe we'll go into why that's almost mathematically impossible given the demographics changes in the world and the level of debt at this point in time. But if you think that's going to happen, I'm here in Arizona, and like the saying says, I've got some oceanfront property right up the road that I'd like to sell you if you think that's going to happen. And so this, over the next coming decades, the global debt has to keep expanding. Otherwise, there's a completely different world that we're living in. But for this world to keep going, it has to. And that's been the fundamental driver of gold. That's what's taken gold from where it was in early 2000s at a few $100s to $3,500. The day-to-day headlines might take it from 31 to 35, but that's not necessarily what took it from 1,000 to 3,500. Warren Buffett's mentor Benjamin Graham used to say, in the short run, markets are voting machines. In the long run, they're weighing machines. And the global debt and increase of money supply is the long-term fundamental driver growth of gold price, and it's very, very unlikely to change in the coming years.
And gold continues to be called a safe haven, but so many people are jumping on board and saying, I see a $4,000 price in 2026, Philip. Do you agree with that?
Yes, I think that is definitely within reach, and it's not at all beyond reasonable expectations. In fact, we're seeing projections in that range of $4,000 this year or early next year from the likes of Goldman Sachs and J.P. Morgan. So I think, and one of the things that has been very clear during this rally is that the forecasters have been behind the curve on gold. Gold has consistently forced them to reassess their projections and raise them. Early this year, it was almost laughable where these projections, these forecasts for gold prices would come out and then gold would exceed them, and they'd be forecasts for the end of this year, and gold would exceed those forecasts within a matter of weeks. So I think $4,000 is definitely a reasonable estimate within the next 6 months or so. And I think it will run further than that. One thing that we never talk about, we talk about the demand forces that are working on gold. We rarely talk about the supply side. And supply side is crucial, of course, in any market. And what we've seen is a marked inability of the industry to significantly increase production of gold, despite this remarkable rise in prices. And it takes a long time to get gold into the market from the time when it's discovered through mining and then processing. These mines often take 15 years before their gold begins to hit the marketplace. So, and other mines are running out during that period of time. So I think we really are in a situation in which increasing demand and these restraints on supply are going to drive this market in the long term.
Brad, is it kind of fun for you to watch the forecasters catch up, so to speak, as they're forecasting what gold's going to do late 25 and into 26, and you're thinking, I saw that a couple of months ago. Glad you're finally catching on.
Years ago. We've been talking about it for years. And so media and typical financial advisors have historically had on their radar. It's not something that they offer. It's not something that they're incentivized to put folks into. So kind of watching them scramble and sort of come to a realization that, wait, this has made a portfolio in much better. My clients would have done a lot better over the last 25 years if I had had an allocation to gold. Sort of watching them sort of come to that realization and sometimes trying to justify or defend it has certainly been an entertaining experience.
I remember when I was director of the Mint, gold was $250 an ounce. And here we are, 13 times that today? So it's been quite a run.
Forecast looks great, continued, and we don't have to worry about that oceanfront property, Brad. Thanks so much to both of you. Brad Chastain, thank you.
Thanks for having me.
And Philip Diehl, thanks as always.
Thanks, Mike.
That is all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. Hey, if you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our very friendly account executives. They're going to be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.